Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.
This website makes learning so easy. I found all my resources here.
Like what you share.
All right, let's get right into it. Welcome everyone to this explainer on strategic financial management. If you're a focused learner looking to master the actual mechanics of how massive corporations make their absolute most critical decisions, well, you are in exactly the right place. Today, we're exploring the really fascinating intersection of academic financial theory, rigorous global exam standards, and real-world corporate strategy. We are going to break down the exact models and frameworks that top-tier financial leaders use to maximize enterprise value and, just as importantly, defend against high-stakes risks. Here's our roadmap for today. We'll hit the foundations of strategic finance, comparing global certification exams, putting math into practice, governing corporate risk, and wrap up with the future of finance. Let's get moving. Section 1. Foundations of Strategic Finance. Let's unpack the theoretical architecture of capital structure and corporate finance. You literally can't talk about corporate finance without starting with the seminal propositions of Modigliani and Miller, or for short. Now, in a perfect, frictionless market with absolutely no taxes, Proposition I states that a company's value is entirely independent of its capital structure. But as we all know, we don't live in a frictionless world. We have corporate income taxes, and because interest payments on debt are tax deductible, it creates what's known as a tax shield. This means adding debt actually adds value to the firm, well, up to the point where the looming costs of potential financial distress outweigh those tax benefits. So to evaluate firm-wide investments in this reality, companies rely on WACC, the weighted average costs of capital. Think of WACC as the ultimate benchmark. It calculates the blended costs of a company's equity, debt, and preferred stock, acting as your primary discount rate. Bottom line, if a project cannot beat the WACC, it's generally destroying value. But here is where it gets a little tricky. You can't just use a historical company-wide WACC for every single new project, especially if that new project has a completely different risk profile than the parent company. So how do we prevent companies from accidentally funding terrible projects? We use the Capital Asset Pricing Model, or CAPM, which calculates expected return based on a specific asset's systematic risk. You've probably heard of this, it's known as beta. And to really isolate the risk of a new distinct project, financial managers use what are called pure play techniques via the Hamada equation. The Hamada equation allows you to strip away the financial leverage risk to find the fundamental business risk, the unlevered beta, and then re-lever it for the specific project. To translate that into plain English, it forces managers to use a risk-adjusted hurdle rate so they don't blindly throw money at highly volatile projects just because the company's overall baseline happens to look safe. So how do we actually know if all this is working? Well, traditional accounting metrics like net income or return on equity actually fail to capture true wealth creation. Why? Because they completely ignore the opportunity cost of equity capital. That is exactly why strategic financial management relies heavily on economic value added, or EVA, and free cash flow to firm, FCFF. EVA measures operational residual wealth, basically what's left over after you have paid for the cost of all capital, including your equity. Meanwhile, FCFF models project out future operational cash flows and discount them back to today. These are the absolute essential tools for measuring true, bottom-line economic reality. Moving right along to Section 2, comparing global certification exams. Let's see how these massive foundational theories are actually tested worldwide. This is such a brilliant illustration of different financial training philosophies. We have a direct comparison here between the US CMA exam administered by the IMA and the Indian CMA Final Paper 14 administered by ICMAI. Just look at the primary focus. The U.S. exam is heavily weighted toward executive decision support, corporate finance, and risk control. It's very much about testing your ability to sit in the boardroom and allocate capital effectively. On the flip side, the Indian exam leans heavily into quantitative modeling, deep mathematical derivations, advanced derivatives, and security analysis. Basically, one tests you as a strategic decision maker, while the other tests you as a rigorous quantitative architect. But regardless of the jurisdiction, professional exams are evolving. The USCMA, for instance, is shifting toward case-based questions, or CBQs, replacing those long-form prose essays with interactive item sets, drag and drops, and direct numerical entries. Now, while that might save you from the absolute agony of speed typing an essay, the underlying difficulty hasn't actually changed. Candidates still have to climb the cognitive ladder of Bloom's taxonomy. You start at basic knowledge and comprehension, sure, but to pass, you have to reach synthesis and evaluation, literally formulating enterprise risk strategies and recommending strategic acquisitions under capital rationing. It completely removes the linguistic padding and demands pure calculation accuracy and logical precision. Section 3. Putting math into practice. All right, let's shift gears, bring the energy up, and actually gamify this a bit. We're going to solve 3 real, recent global exam paper scenarios together. Here's your first scenario. Grandeur Industries is evaluating capital projects using CAPM. The current risk-free rate in the market is 4.0%, and the expected return on the market portfolio is 10.0%. They're looking at Project Gamma. Now, Project Gamma promises an internal rate of return, or IRR, of 13.0%. However, it's a risky project. It carries a high beta of 1.60. So what's your call? Based on this data, should Grandeur accept Project Gamma? The answer? Reject it. And here is exactly why. You have to calculate the project-specific required rate of return using CAPM. You take that 4% risk-free rate and add the risk premium. The market premium is 6%. That's the 10% market return minus the 4% risk-free rate. You multiply that 6% by Gamma's high beta of 1.60, and you get 9.6%. Add that back to the 4%, and the required rate of return for this specific project is actually 13.6%. Since Project Gamma only offers a 13.0% return, accepting it would literally destroy shareholder value by a spread of negative 0.6%. If you had used a lower, unadjusted corporate WACC, you would have made a terrible mistake. Okay, let's move to scenario 2. Apex Manufacturing, a Canadian enterprise, has an annual capacity of 1,500 units. They currently sell 1,000 units domestically for $2,000 each. Their variable costs are $1,000 per unit, and their fixed overhead costs are $600,000 annually. Suddenly, a foreign customer offers a special one-time order for 500 units, but at a steeply discounted price of just $1,200 per unit. Crucially, no additional fixed costs will be incurred, and regular sales aren't affected at all. Do you accept the special order? Yes, you absolutely take it, and you walk away with a cool $100,000 in incremental profit. The trick here is recognizing that the $600,000 in fixed overhead costs are sunk. They are completely irrelevant to this specific decision because they do not change. All that matters are the differential revenues and costs. You're getting $1,200 per unit, and your variable cost is $1,000 per unit. That leaves you a positive contribution margin of $200 per unit. Multiply that by the 500 units, and bam, you've just added $100,000 straight to the corporate bottom line. All right, last quick-fire math scenario. An institutional investor buys a government bond with a face value of $100 for an issue price of $94. Exactly 1 year later, after receiving an annual coupon payment of $6, the investor sells the bond in the secondary market for $105. What is the total realized annual return on this investment? It's 18.1%. This brilliantly illustrates how total return combines both cash flow income and capital appreciation. Think about it. You received $6 in cash income from the coupon. Plus, you bought the bond for $94 and sold it for $105, which is an $11 capital gain. So your total gain is $17. Divide that $17 by your initial purchase price of $94, and you get an 18.1% total realized return. Simple, elegant, and absolutely vital to get right. Section 4, Governing Corporate Risk. Now that we've crushed the math, let's step back and look at the bigger picture. We are moving away from spreadsheet formulas and into the realm of high-stakes corporate survival. You see, strategic financial management extends deeply into enterprise governance and ethics. A massive part of this is mitigating behavioral vulnerabilities, which is perfectly captured by the fraud triangle. The fraud triangle states that organizational fraud happens when three specific dimensions intersect. First is pressure, think unrealistic earnings expectations or executive compensation tied to short-term stock bumps. Second is opportunity, which is created by weak internal accounting controls or poor board oversight. And third is rationalization, where individuals psychologically justify their unethical conduct, like telling themselves they're just making a temporary adjustment to the books. Robust enterprise risk management, or ERM frameworks, are deployed specifically to identify and sever these vulnerabilities before they destroy a company. Now, what is truly fascinating here, and honestly kind of funny, is the sheer drama of corporate restructuring defense mechanisms. When a hostile takeover is looming, financial managers deploy tactics that sound like they belong straight in a fantasy novel. You have the poison pill, which dilutes the hostile bidder's equity by letting existing shareholders buy discounted stock. You have the white knight strategy, where you literally beg a friendly acquirer to buy you out instead. You have the staggered board, which makes it impossible for an attacker to replace the whole board in a single vote. There are golden parachutes, which make firing top executives so incredibly expensive that the acquisition loses its appeal. And finally, leveraged recapitalization, where a company intentionally takes on massive debt just to make themselves look completely unattractive to buyers. It is literally high-stakes chess using corporate structure. And that brings us to our final stop. Section 5, the future of finance. How is all of this theory and governance adapting to the modern world? Well, the modern financial environment is undergoing a massive paradigm shift. First up, digital finance is entirely rewriting the rules of liquidity management through machine learning, automated treasury systems, and distributed ledger technology. Simultaneously, we're seeing the integration of ESG, environmental, social, and governance criteria, into corporate reporting. And let me be clear, this isn't just a buzzword. It is structurally transforming capital budgeting. Financial managers now have to adjust their cash flow projections to account for climate transition risks, regulatory compliance expenditures, and actual carbon liabilities. Integrated reporting frameworks are merging traditional financial statements with these non-financial indicators to give a truly complete, holistic view of sustained value creation. So based on the synthesis of all this doctoral literature and global standards, what are the actionable takeaways? Corporate leaders have to execute 4 key structural adjustments. 1. Implement risk-adjusted hurdle rates. Use the Hamada equation for specific projects rather than relying on a lazy company-wide whack. 2. Transition performance evaluations to residual economic wealth metrics, like EVA, to align executive pay with long-term shareholder wealth, not just short-term net income. 3. Expand risk management to include digital infrastructure and ESG integration. Your capital budgeting must factor in things like cybersecurity and carbon offset costs. And 4. Ensure professional education continues to align with these real-world interactive case-based demands. Which brings us to our final thought. We've journeyed from Modigliani and Miller's capital structures, up the cognitive steps of Bloom's taxonomy, through the mathematical trenches of risk-adjusted hurdle rates, and straight into the future of digital and ESG integration. So I'll leave you with this question to ponder. How ready is your organization for the convergence of digital finance, ESG, and rigorous risk modeling? Are you actively defending your enterprise value, or are you just relying on outdated, unadjusted historical data? Keep pushing your understanding, keep asking the hard quantitative questions, and I will see you in the next explainer.
Like what you shared.
This website makes learning so easy. I found all my resources here.
Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.